share his thought on what the next steps are, especially for businesses. Now, of course, as we speak now, the regulations are not yet issued, so we're still expecting the tax regulation itself. But we will share our experience today with the based on some of our experience in other jurisdictions. Now, as you can see already, now I'm going to go to this slide where if you can see what has led to the introduction of corporate tax in the UAE. So this is not something that happens overnight. So this has been prepared since 2018. Now, if you would ask the questions, let's say as businesses in the UAE, why would there be so many regulations being introduced in such a short period of time, right? But the way I look at it, and as also has been expressed by the government, is that they want to make sure that the UAE is at par, or the way how business is being conducted here is at par with the global best practice, right? Even last year, I did also research in terms of trying to correlate the impact of the new regulations that have been introduced in the UAE and the FDI inflow into the country. And if I look at the data that has been, let's say, presented by basically independent global organization, is that you can increasing for a few years despite the COVID pandemic that we have. And therefore, I think that this move should be a good move that needs to be seen as a positive move also by the business community in the UAE. And personally speaking, having lived here since 2009, you can see that the changes as well. And also I can add to those numbers, those positive numbers, is that those changes have increased even more the confidence of the foreign investors and also international business community on the actual investment to the UAE, right? Another thing that is going to be even more important, and it will be also outlined by my colleagues, is that technology, in terms of for governing or for the governance of your company, especially on the finance and accounting part, will be even more important, right? Looking back into the introduction of VAT back in 2000 and let's say 18, we have helped a lot of businesses to basically get ready or being ready or being fit to be in compliance with the new tax that was introduced at that time, which was the VAT. But now it's not much different, because there is a new type of tax which is so-called corporate tax, and basically you need to also make sure that whatever system that you have, whatever corporate structure that you have, so on top of the technology, maybe the corporate structure that you have will ensure your compliance to this new regulation. Now, today, our two colleagues here, Alessandro being, having had some of his experience, and also Rushabh, especially with his experience in India with one of the big four there. So I think that will be able to help. And I just want to also mention from Alessandro a bit of his profile as well, is that he's currently the member of the technology committee of the CFE. So CFE is the organization of European tax advisors, right? And basically the 26 European countries, so tax advisors from 26 European countries are part of this organization. And if you look at as well into the introduction of VAT as well, the ESR, the laws that have been implemented have taken the law in the EU as the inspiration. And I do not see it differently as well, because if you look at the corporate tax that we have now, which later on you will see that we have 3 types of rates, and the last rate is not yet revealed yet as of now, but it is my guess that it is linked to the OECD BEPS Pillar 2, which basically saying, look, you know what, the country needs to implement certain level of minimum of corporate taxation. And as we speak now, the EU is currently in discussion, or let's say the EU countries are currently discussing the minimum tax directives, which needs to be also implemented in their respective countries. And once this is implemented as well, then it will also impact us in the UAE in terms of our corporate taxation, and that's maybe where you can get a peek as well on what the third rate would be, right? And if you look at it, this corporate tax in the UAE landscape, I think the landscape is a bit incomplete, I would say, because maybe it is complete from the federal tax perspective, but it is incomplete in the way that if you look at the UAE as a whole, because as some of you might be aware of, there is already currently Emirates level corporate tax regime in some of the Emirates, right? For example, in Dubai and Abu Dhabi, and this is for oil companies and also for foreign branches of foreign banks. So this is just the landscape that we want to give is from the federal perspective in the UAE. Now, I guess that's it from my side. Rushab, and I'll give it to both Rushab and Alessandro for the next slides. And I hope that our webinar today will be also very useful for all of you. And again, this is not our first webinar. We are planning to have upcoming, let's say, a series of webinars in the next few months, just to share our thought, our experience, and also updates if there is any from our tax authority. Okay, so enjoy the rest of the webinar. Thank you.
Hello, everyone, and thank you very much, Marcus, for the introduction. I think you covered some very key topics that we will uncover the more we go forward with the webinar. So as you presented, I'm Alessandro Valente. I'm an international tax and transfer pricing manager at Crowe UAE. And it is a pleasure to be here with you all today to discuss this very interesting and exciting topic. So as Marcus mentioned, as a member of the CFE Tax Advisors Europe, which is an association which brings together 33 national organizations in 26 European countries and represents more than 200,000 tax advisors worldwide, I've witnessed some of the recent changes in the EU tax landscape that I believe that will soon make an impact on taxpayers worldwide. As Marcus was saying, there is no question that the OECD and the EU are being the main driving forces behind many of the changes, the radical changes that are affecting the tax world. So just as a bit of background, as you know, on the 20th of December 2021, with the release of the Pillar 2 model rules, the OECD provided a very precise template for governments to move forward with the two-pillar solution. And this was to address the challenges, the historical challenges that have been created by the digitalization and globalization of the economy. The model rules define the scope and set out the mechanism for the global anti-base erosion rules under Pillar 2 with the mentioned 15% rate that we believe that will likely be the last unannounced rate for large multinationals in the UAE. And non-coincidentally, on the 22nd of December 2021, the European Union, the Commission specifically released a proposal for a council directive that gave kind of a template for European countries to implement such measures at the national level. And over a month later, on the 31st of January 2022, the Ministry of Finance of the UAE published the FAQ that we're now using as our main source of information for this webinar and for the moves the company need to take within the next couple of years. So by observing why did I mention all this is because by observing the trends that are set by OECD and specifically the EU, we can get an informed idea as to the direction that most world countries will take, and this obviously includes the UAE. So going to today's slide, so what exactly is the scope of the upcoming corporate tax regime in the UAE? Well, it will cover, first of all, UAE businesses. There are both mainland entities and free zone, interestingly, even though there is currently no difference between free zones and financial free zones. So they're both included. Then it covers individuals undertaking commercial, industrial, and/or professional activities in the UAE. It also covers activities carried out under a freelance license or permit. And finally, and interestingly, foreign entities and individuals which are conducting trade or business in the UAE in an ongoing or regular manner. Let's go to the next slide, please. So yeah, here, as you can see, we mentioned the exemptions that have been included as part of this announcement. And the first one is related to businesses and commercial activities dealing with the extraction of natural resources. As Marcus was saying earlier, these activities always receive special treatment, and this is no exception. Even though the Ministry of Finance has clarified that businesses dealing with the extraction of natural resources will still remain subject to the emirate level of corporate taxation, which can currently go as high as 55%. The second exempted item of income regards interest and other income that is earned by individuals from bank deposits or savings schemes. The third is salary or employment income earned by individual persons. The fourth item, and perhaps the most important, regards dividends, capital gains, and other income earned from owning shares or other securities by individuals in their personal capacity. And this includes also UAE businesses that earn those from their qualified shareholdings. The fifth is in relation to investment in real estate by individuals, again, in their personal capacity. And finally, to conclude with foreign investors' income, which relates to dividends, capital gains, interest, and in this case, even royalties and other investment returns. Now on to slide number 7. Yeah, so in this slide, we decided to do a little focus on free zones and financial free zones obviously being very important for business in the UAE and being one of the peculiar aspects of why this country is so interesting for investors. And so we will outline the applicability of corporate tax to such free zones. And as previously mentioned, free zones are not excluded currently from corporate tax. And therefore will be required to register and file a corporate tax return. This is despite the fact that free zones and financial free zone businesses will obviously, as I said, be subject, but will enjoy those incentives as specified by the Ministry of Finance. Will continue enjoying those incentives that are currently being part of. So with this, I will conclude my first part. I would like to leave the floor to Rishab, who will highlight some information regarding the corporate tax rates, as well as the transfer pricing implications of this announcement.
Thank you, Alex. Thank you, Marcus, for setting the stage and providing the brief, the objective of introducing the corporate tax regulations and what is included in the scope and what are the exemptions provided. Firstly, let me give some introduction. My name is Rushabh Vora. I am working as a senior manager for international taxation and the global transfer pricing. As Marcus highlighted as well, I'm coming from the India background and working on certain complex corporate tax regime. While there are many interpretation issues, many litigations on the complex topics, possibly that would really help me in advising the clients in terms of corporate tax in UAE, which is possibly quite a simpler at present, in line with the UAE government's objective, always to make things simpler as compared to the complex things globally. In addition to that, the global transfer pricing is something the area, to advise the clients on the multiple jurisdictions from Middle East to Africa, from Asia, to advise on the overall aspects of the framing of the transfer pricing policies. That is something quite a subjective topic, and I really enjoyed during, providing this kind of advisories to the clients. So that is something, my broad introduction with that. Coming to today's slides, while Alessandro already mentioned the exemptions and the scope to that, let us have a more insights on what are the tax rates that has been prescribed by UAE Ministry during the announcements. So UAE Ministry has provided 3 buckets for the corporate tax rate at the moment. The first bucket is quite simpler, wherein they have provided the exemptions for the taxable income up to AED 375,000. And on that particular income, the tax rate of 0% rate would be applicable. In a simplified manner, there will not be any tax for the taxable income earned by the taxpayer up to AED 375,000. In addition to that, whatever the income which is in addition to the taxable income of AED 375,000, those income would be taxable at 9% tax rate, which is also, I would say, that possibly quite lower as compared to the global tax rates, as compared to the neighboring countries. And UAE Ministry have tried to maintain its preliminary objective to maintain a consistency to ensure that they are competitive country across the globe. At the same time, they want to continue compliance with OECD BEPS project. So the tax rate right now is quite at a lower end, I would say, and possibly this is something that will definitely ensure the compliance, at the same time protect the investors' interest. Interestingly, there is third category as well, for which the tax rate is not yet prescribed. The category belongs to the large multinational organization, as Marcus and my colleague Alessandro also highlighted. The overall objective of introducing the corporate tax regime is in line with the OECD's BEPS Pillar 1, Pillar 2 project. In that particular category, the large multinationals, which generally consist of the groups having a consolidated turnover of euro exceeding 750 million euro, which is equivalent to AED 3.15 billion. For this particular category, the tax rate is not yet prescribed, but we expect that the tax rate will be going to be either 15% or possibly more, similarly in line with the OECD BEPS Pillar 2, which UAE has also committed to implement and agreed to. So possibly this would be the category. We will see the further updates from the ministry very soon on this particular category. I would like to highlight one interesting point here. In addition to this tax rate, in line with the OECD Pillar 2 project, there could be some announcement relating to top-up tax for the UAE headquartered entities, especially Definitely, right now we have not heard anything on that aspect from the ministry. But since UAE has committed to implement OECD Pillar 2, there could be possibly of implementation of top-up tax as well, which is mainly applicable for the UAE multinational headquartered entity. This is just to give you a glance, as I was discussing the corporate tax rate of UAE, which was mainly 9% for most of the taxpayers. So let us have a kind of discussion on what are the corporate tax rates in the neighboring countries right now. If we talk about the GCC countries right now, most of the other countries like KSA, Oman, Kuwait are having a corporate tax rate of 15 to 20% at the moment. Similarly, Egypt and Turkey are also in line with the similar corporate tax rate of 22% or 20%. While Bahrain has not yet introduced the corporate tax till now, similar to in line with the UAE, which has introduced the corporate tax recently. Bahrain is also a member of OECD BAPS project, and we may see some update from Bahrain side as well. But if I talk about the UAE particularly, the tax rate of 9% at the moment is quite a competitive and lower than the GCC countries or the neighboring countries. If I add more onto that, the average rate of OECD countries is close to 23%, and at the same time, average corporate tax rate for European Union nations countries is close to 21%. So if we compare the UAE's tax rate with the OECD or European Union member country as well, the corporate tax of 9% is quite a competitive, and this would possibly be in line with the government's overall objective to maintain a sustainable growth and to comply with the international tax reform as well. Let us have some thoughts around what would be the mechanism to compute the taxable income. We just discussed the corporate tax rates, but it would be quite interesting to see how could be the mechanism of the computation of taxable income would work. While we have not received detailed regulations or the rules to compute the taxable income, but some glimpse of the regulations or some glimpse of the rules have also provided in the announcement. We have created an example here, a hypothetical scenario. So let us assume a particular taxpayer has earned a net profit of 1 million dirham, which is the net profit before tax as per the financial statement. Generally, as per the global standards for computing the taxable income, we take the base of net profit as per the financial statement. That is the standard practice followed by most of the countries to compute the taxable income. So as we discussed, that there is a 1 lakh dirham of profitability for the taxpayer. Now government of UAE has also allowed to undertake certain adjustments. We are yet to hear in detail what could be those adjustments, what would be the expenditure would be allowed as a deductible expenditure, etc. First, we will see some updates in the future as well. But considering the global practice standards, there would be certain expenditure generally which are incurred mainly for the business purposes would be allowed as a deductible expenditure. And in case there would be certain expenditure which are incurred not for the business purpose, not for, or in fact those expenditure incurred to earn a exempt income like dividend or capital gain, those expenditure will not be allowed as a deductible expenditure, and possibly we have to add those expenditure to increase the taxable income. So giving a few examples of those deductible or non-deductible expenditure, like any expenditure relating to, let's say, rent, professional fees, legal fees, which are all, or the operational expenditure definitely, which are all relating to the business purpose, would be allowed possibly as a deductible expenditure. Certain expenditure like provision for doubtful debts, provision for tax, certain other expenditure incurred to earn the exempt income of dividend or capital gain, those would be the category of expenditure which may not be allowed. At the same time, the income, the other income like dividend or capital gain, which has been separately excluded from the scope of the corporate tax, which my colleague Alessandro has also explained, those income would also be reduced from the net profit to compute the taxable income of a taxpayer. So these are a certain category of expenditure and the income which may or may not be allowed. Definitely, there will be certain additional expenditure of royalty or management fees or interest expenditure which are incurred while transacting with the related parties. Those expenditure would also be allowed as a deductible expenditure, provided they comply with the arm's length principle of transfer pricing. We will discuss that in the coming slides, but we have to see what would be the arm's length price for those kind of expenditure for related party transactions, and only up to those limit the expenditure would be allowed. After computing those adjustment, let us arrive the total taxable income of, let's say, 700,000. So as we discussed, the first 375,000 income, there would be no tax, and only on the balance income of 325,000 in this particular scenario would be taxable at the rate of 9%. So this would be the simplest mechanism right now, I would say, to compute the taxable income. Definitely, we would await more rules, await more clarifications or a guidance in terms of the rules to compute the taxable income, to get the more clarity on the deductible expenditure, because that is something is always a controversial issues across the globe, which are the deductible expenditure or no. But we will get the more clarity from the ministry soon. Administrative part. At the moment, ministry has already announced that it would be required for all the taxpayer, for all the businesses operating in UAE to register for the corporate tax. Definitely, we have not yet received much updates on the registration process or the compliance requirement to register, but this would be required for all the businesses, which also includes the free zones and the financial free zones. In terms of corporate tax return, UAE ministry has kept it at a very simpler level in terms of objective of ease of doing the businesses. Only one corporate tax return would be required per year. Doing corporate tax return, no provisional corporate tax return would be required at the moment. So, basis the announcement which we have received a week ago, only the one corporate tax return would be required. Definitely, the form has not yet prescribed. The compliance process is also not yet prescribed, but we would see that once we, get more clarity from the ministry. At the same time, the non-compliance, as we have already seen that ministry for the other compliances like VAT, for economic substance regulations, and for other non-compliances, they are quite stricter in terms of levying the penalties for non-compliance. Similarly, for corporate tax non-compliance, they have mentioned that if there is any non-compliance, there could be a stringent penalties. We are yet to hear what could be the penalties, what are those non-compliances area. We will get some guidance from the ministry very soon on this aspect. Overall, Ministry of Finance is the overall competent authority for the corporate tax regulations and the transfer pricing regulations in UAE. Definitely, this is something similar in line with where the Ministry of Finance is the competent authority for other regulations as well, like country-by-country reporting, FATCA and CRS, in terms of to manage the bilateral and multilateral arrangements, and for definitely the exchange of information with the other countries for tax purpose. So Ministry of Finance would be the overall competent authority. At the same time, Federal Tax Authority would be the authority who would actually enforce the regulations, who would undertake all the administrative tasks, imposition of penalties. So all those things would be taken care of by Federal Tax Authority in line with the other regulations as well, which are already ongoing in UAE. Implications on transfer pricing. We already discussed what are the corporate tax. So it is something very unique that corporate tax and transfer pricings generally go hand in hand. In fact, transfer pricing is just regulations, that would be applicable in most of the countries where the corporate tax regime is existing at the moment. Now, let us understand why transfer pricing rules are so important whenever there is a corporate tax regulations has been introduced. Basically, transfer pricing is a price which is undertaken at which the price at which the transaction is undertaken between two related parties. So, for example, there is a UAE taxpayer which has a related party, let's say in Saudi Arabia, or let's say in any country of Europe. UAE taxpayer have any kind of transactions in terms of charging of royalty fees, charging of management fees, or provision of some services or sale of goods. So these are the transactions which are generally quite routine for the multinational organizations. Now, for all these kind of transactions, that would have an impact on the profitability of the taxpayer, income and expenditure of the taxpayer, and that would also have a consequential impact while computing the taxable income for the taxpayer, on which the taxpayer have to pay the corporate tax. Because of this particular reason, whenever there is a intra-group transactions, the income and expenditure would have a significant impact on the taxable income of the taxpayer, and that way the corporate tax to be paid by the taxpayer may get significantly vary, depend on the transactions. And therefore, there would be an increase in concerns from the Ministry of UAE as well, whenever there is an intra-group transactions, that allocation of tax revenue to UAE, whether it is fair or it is not fair. So that would be the increasing concerns for all the countries wherever there is a corporate tax regime, and in UAE as well, it will going to be happen very soon now, because the corporate tax regulations are in place. So that means all the UAE businesses which has undertaken the intra-group transactions at the moment would be required to adhere to transfer pricing principles in UAE. Definitely, we have not yet received the detailed rules and the guidance, but good thing is that Ministry has already clarified that UAE will adopt the transfer pricing rules in line with the OECD transfer pricing guidelines. As you may be aware that presently UAE has already introduced the country by country reporting, which is one aspect of the transfer pricing regulations. Similarly, we are expecting that UAE will also introduce the concept of local file and a master file in line with the OECD transfer pricing guidelines. So that means what is required by the taxpayer now? That means all the UAE businesses, whether it's a UAE headquartered entity or a UAE subsidiary entity, if it is undertaking a related party transactions or intra-group transactions, they have to formulate a transfer pricing policy. They have to document the facts in terms of what are the risks, what are the functions of UAE entity and the counterparty. At the same time, whether the profitability of the UAE entity is in line with the market conditions or no, that UAE entity have to demonstrate and justify, so that to ensure that it is paying a fair share of taxes to UAE authority. There are certain unclear areas at the moment whether the transfer pricing regulations will apply on the domestic transactions as well or no. We are awaiting the response from the Ministry or the clarity on this aspect. Definitely we'll get to see more detail on this aspect. At the same time, the rules have also provided certain exemptions on qualified intra-group transactions. Again, we have not received much clarity on what would be the qualifying intra-group transactions. There could be certain safe harbor regulations in terms of that depends on the category of the transactions, and there can be a certain safe harbor rates, which is the practice ongoing in many other countries across the world. It's quite early to mention those aspects right now, but just to give you a glimpse on that, we will expect more clarity on this particular category in future. At the same time, there could be certain related party disclosure as well in terms of additional compliance activity, which may be applicable. Again, we have not received more clarity on the compliance to be undertaken for transfer pricing rules, but in many other countries have already prescribed those kind of additional compliance requirement, we will get to see that in more detail once the rules are published by the ministry. But at the moment, what is required is try revisiting the intragroup transfer pricing policies and start preparing the transfer pricing documentation. In fact, we have many of the time experienced that there are no intragroup agreements also in place. At the time of audit, auditors also highlight this important aspect to many of the taxpayers that for any kind of transactions, there should be some intragroup agreement providing the important terms and the conditions, the pricing policy, etc. So all these things would be more important now onwards, and the time gap of 16 to 22 months provided by the ministry, that is to implement all these practices, to implement all the gap areas, and therefore it would be important to analyze all these aspects. Just to give you an example how the transfer pricing mechanism would work, as we already highlighted that it would have an impact on the corporate tax regulations. We have created a simple example here wherein there are two entities A and B, assuming both the entities are related parties. KSA entity, which is A entity, has sold goods to UAE entity at 910. Keeping all other aspects constant, which are third party aspects, KSA entity has earned a profit of, let's say, $10 and paying a corporate tax on that $10 at 20%. UAE entity, which has purchased the goods from the KSA entity at, let's say, 910, it is reselling those goods at 1,350 to a third party customer. By deducting other cost of the operational cost, UAE entity is earning let's say a profit of $140 and paying a corporate tax of, let's say, 9%, and that would be a term of corporate tax that UAE entity have to pay under situation 1. Overall, in situation 1, for a group, the consolidated tax would be $14.6 for the group as a whole. Similarly, in situation 2, keeping aside all other facts constant, we have just modified the pricing, the intragroup pricing of KSA and UAE entity, wherein the KSA entity would sell the goods, let's say, at $1,000 to UAE entity. Considering that the KSA entity's profit would increase from 10 to 100 and it will pay the corporate tax in KSA at 20%. On the other side, the UAE entity, the profit will significantly go down and it has to pay a corporate tax profit on that reduced taxable income of the UAE entity, and that would be only $4.5. Consolidated tax in the situation 2 for a group would be 24.5. But the important part here to be noted as for the UAE ministry, it will only receive the corporate tax of 4.5 in the situation wherein the pricing entity has undergone significantly. So in that case, that would be important from the transfer pricing perspective to ensure that the pricing is in line with the market conditions to justify that UAE entity is paying a fair share of taxes in UAE. So that would be important from now onwards. And that's how the ministry will also look into the details to ensure that they are getting a fair share of taxes in UAE. So with this, I end my session here and hand over to my colleague Alessandro to discuss more on other key aspects of the corporate tax. Alessandro,
thank you very much, Vishal. And thank you for your outline of the transfer pricing and the rates. And we will now look at some of the key aspects that were mentioned in the FAQ by the Ministry of Finance. These are obviously very important and will be clarified going forward in the coming months. But this is the information that we have as of now. So in relation to advanced tax, it has been clarified that only one corporate tax return will need to be filled per financial period. So no provisional or advanced corporate tax filings will be required. In addition, the UAE businesses will not be required to make any advanced corporate tax payments. So this is relevant. Going to tax losses, which is probably the area that has been clarified the most by the Ministry of Finance in the FAQ by 31st of January. So it has been stated that the tax losses obviously will arise when total deductions the business can claim are greater than the total taxable income for the financial period. And the FAQ states that the UAE corporate tax regime will allow businesses to use losses incurred in the period to offset taxable income in the subsequent financial years. And this is upon meeting conditions, which are yet to be identified. So we would imagine that the UAE follow very so-called very generous loss utilization rules. And this means that losses could be allowed to be carried forward either indefinitely or at least for a period of 5 years. Where UAE have formed a tax group, we'll see tax group a bit later, but this is in relation to losses. So where your businesses have a tax group, the tax losses from one group company may be used to offset the taxable income of another group company, again, on meeting certain conditions. And it is important to remember that the internationally minimum common ownership requirements for group relief range between 75 to 100%. Such similar common ownership requirements are expected to be used in the UAE. Now going to withholding tax. This is a topic that has been touched upon earlier, but just to reiterate, it's been obviously one of the key elements of this landmark reform. So there will be no withholding tax applicable on any domestic or cross-border payments of any nature. And similarly, no taxes will be levied on foreign investors' income that is derived from dividends, interest, royalties, and other forms of payments. With regard to foreign tax credit, the foreign corporate tax paid on all UAE taxable income will be allowed as a tax credit against UAE corporate tax liability. However, the exact mechanism to compute such foreign tax credit has not yet been provided. So we will update once the information is released. Then on to tax groups. I touched upon earlier in relation to losses. But the FAQ also specified that groups of companies will be able to elect to form a tax group and be substantially treated as a single taxable person. So a UAE group, tax group, will only be required to file a single tax return for the entire group. And finally, on to audit requirements. At the moment, there is no clarity as to whether the audit of financial statements for filing the corporate tax return will be mandatory. However, even in the absence of mandatory requirements, the audit will be recommended as best practice. So I will conclude my intervention here. I would like to thank you all for listening. And I will now leave the floor to Binit Shah, who will provide some conclusive remarks. Thank you very much. And Binit, please.
Yes, hi, Alessandro. Thank you very much. All participants, welcome to the Crowe UAE. Basically, UAE is celebrating their 40th year today. this year, and we are all welcoming to you and your keen interest about the corporate tax. So the thing is that, first of all, thanks to the UAE ministry because see, we have to showcase being in UAE, doing business in UAE. We have to be in line with all the global competitors, global countries where the tax regime is there. And its good thing is that they are coming up with the comparatively very low tax rate. Obviously, a lot of educations are required in the UAE business people, communities about the corporate tax, and we are here for that only. In line with the corporate tax knowledge, we can say, because law has not yet published, we share here our experience from the different countries with the different experts, and we are doing practice of the transfer pricing and international tax since the last many years. So this will help us to deliver you the right conversation and guidance for your tax planning, corporate tax planning, and awareness. So first, how you will evaluate your business and what impact is going to be there. Like first, you need to check your applicability of the regulations on your business, re-examine the fact and assess the applicability of the regulations. Most probably majority companies is covered under this regime because the range what they have given is a 375,000 income. So almost all, I think so, 99% business have increased, except small grocery shops or small stores. Then after the applicability, you have to identify the gap. Like if you want to mitigate this documentations or corporate tax calculations, as that Alessandro said, that technology, Marcus said that technology, you have to start using with the proper accounting solutions, softwares, where you can see that day to day or as and when you want that what is your liability for the tax as a 9%, which can be computed immediately and you can see that. Apart from that, once law will be released, what are the incomes are exempt, which are the considered, we will update you. Similar way, expense, what are the deductible, as Rushabh has mentioned. That those gap will be there and challenges areas might be there to understand that whether it's applicable or not applicable, it is exempt or not exempt. Government has given enough time for us to implement, understand the tax law and set up our own business, implementation like restructuring of your business also in the form of the VAT or in the form of this direct tax of corporate tax. So first of all, maintain all documentations and realign contract wise conduct. Here the contract is very important, as Rushabh has mentioned, particularly in the related party transactions, inter-country, inter-branch, and within even, like say, we have seen in many countries, within a country, related party transaction also need to be taken care. So if you have within UAE, you should have a proper contract and possibly transfer pricing impact may be there or government may consider those impact also. Like if you have a manufacturing unit here, in one company, another company, you have a trading, and third company, you may have an expo, maybe in free zone. So all this structure need to be revalidated, anything need to be taken care. All this need to be, we will assist you in that also. Compliance part, like undertake timely compliance requirement, which is going to be released, but as internally, you have to set up some benchmarking to follow this impact of the corporate tax, and you will have to be, it should be visible to you. You have to keep watch on that also initially, because you need to know that if you find some gap, immediately you have to ask your consultant and get more knowledge in. That's what the update, and maybe as we have seen in the VAT, lot of updates coming. Similarly, we are expecting more updates within the implementation period, 1.5 years almost. So we have to keep update. We will also update you. Our regular webinar series will be there every month. Minimum one webinar will be there, and any significant update came, we will intimate you by email and other aspect. So overall, it's right time to take action is now, and you have to act proactively and share your concern about that or any queries. We are always available. So next step, as what we define that corporate tax impact assessment on your business, as Alessandro say that, for example, if you have multiple companies, you can make a group of the company for the corporate tax, and then you can assess that what are your liability possibly coming. Maybe if you have a 20 company, if you are loss making, if you are profit making, you can set off that, and whatever final profit came, you can pay tax. That could be the group tax structure. Restructuring of operations, your existing operations, whatever, like you have a, say for example, few companies in free zone, different free zone, few companies into the mainland. How you manage that, because as certain free zone has declared the tax free, and similar same owner, same company have a mainland entity also. So in that case, you need to know and understand the restructuring of your operation as well as documentations. Definitely, transfer pricing policy need to be there for any, and it requires the contract between intra-company, intra-branches, which need to be precisely defined, because this is the base where you have to justify your cost, pricing, profit, what you're generating from the business to the government, to the ministry. So it is right. First step, possibly I can say that if everything will be intact, then just revisit that, prepare the transfer pricing policy. There are a lot of exercises is there that benchmark what the pricing in other countries, in-country pricing of your similar product need to be do the assessment through the benchmarking of the products in the standard global database, what we are doing also. Similarly, as Rushabh has mentioned, that intra-group agreement, this is must, and it is required. If it is within UAE, outside UAE, mainland to free zone, you need to have an intra-group agreement, need to be started preparing and keep draft ready. And once the law will be released, we can inline with those agreement according to law, and it could be done as in advance. Anytime anything is related to corporate tax advisory with the multiple countries, any countries like impact, if you have a branch over here in the UAE, if you have a headquarter in UAE and branch having in different countries, see, Crowe is a global top 10 firms, and where we can assist you for the any corner of the world, any corner where you have a presence, we can assist you with help of our global network. So Crowe is always available for you, and for your any query, we always welcome you for that. All above aspects are strongly recommended by us to revisit during pre-implementation phase of corporate tax regime. So this is the, like, you have to start brainstorming, you have to start discussing in the corporate tax impact. Please take advice of consultant, and we are always available for you. That's the time, like we have 3-4 minutes left. Anyone have a questions, they can type into the question answer, and these are the contact detail, email IDs available, as well as you can visit